So, hello viewers, it's me, your Manu Issue. Welcome to my channel Manu Issue ACCA classes. In today's video, we are going to do next questions of F7 from the chapter consolidated statement. So, in previous question, in previous video, I have done few questions. Now we will move ahead. So, if you are watching my video for the first time, please like and subscribe to my channel and share it among your friends. So it's my request. So, okay, before reading the question, let's know what the requirement of the question is. The requirement of question is, first is prepare extracts from PLASTIK consolidated statement of profit or loss for the year ended 30 September 20X4 for revenue, cost of sales, finance cost. Okay, it means we don't have to calculate all the items of the P&L, just we need to calculate these three items, which is revenue, cost of sales, finance cost. Next, we have to prepare the consolidated statement of financial position for PLASTIK as at 30 September 20X4. Okay, fine. So let's move. Let's read out the question. Okay. So before starting, before reading the additional information, we will do the 5 working, right? So first we will only do here. We will only do the first one working, which is just wait. Okay, yeah. So before reading the additional information, we will just do first working 1, which is for the group structure, right? Okay, so here PLASTIK acquired. Okay, read out the question from the first. On 1st January 20X4, PLASTIK acquired 80% of equity share capital of Subtract. Okay, it means PLASTIK acquired 80%. So who is the parent company? PLASTIK is parent, right? And who is subsidiary? Subtract is subsidiary. And how much percentage is owned by parent? That is 80% on 1st Jan 20X4, right? So, and what is the year end? Year end is 30 September 20X4. So, time of acquisition, I will write in the shortcut TOA, which stands for time of acquisition, which is of 9 months. Okay. So, what is the NCI percentage? NCI percentage is 20, because out of 100, 80% is acquired by the PLASTIK, which is who is the parent. Okay. So now, after doing this, the next sentence is, the consideration was satisfied by share exchange of 2 shares in PLASTIK for every 3 shares acquired in Subtract. Okay, it means we need to find out total purchase consideration. I will write in the shortcut again. Okay, total purchase consideration. The first one is share consideration, or we can say share exchange. Okay. So here, first I will write in the bracket to show you what the actual calculation means. Then I will show the final calculation. Then here 80%. First we will take 80% of total shares of Subtract. And where can we get this information? From the balance sheet of subsidiary. Here you can have in equity section, the equity share of $1 is there. 1 means the nominal value. Okay. The 9,000 is the, we have already taken this 30 common, so I am writing 9,000. Because in question, I think all the figure have been calculated in the thousand. Here you can see, so be careful with this. If this thing has not been mentioned in the question, you can take the full figure. No need to just take it 30 as a common. Okay. So here, if nominal value is 1, it means number of share is 9,000. So be careful with nominal value as well, because sometimes in the question it might be indicated the nominal value is 0.5. in that case the number of share will be different. Here the nominal value is 1, that's why the number of share is 9,000, so no issue. So now out of 9,000, 80% share is acquired by the parent, right? Okay. And how much share the parent give and take from the subsidiary? The parent has given 2 share and taken 3 from the subsidiary, right? So here we will multiply 2 into 3. Okay. Then again we will multiply with the fair market value of parent, which is given the question. So at the date of acquisition, shares in Plastic and Subtract had a market value of 3 and 2.50 each respectively. So 3 is the market value of parent. Okay. So now this is the actually what the calculation is, and final figure will be included. I will show in this box. So 80% into 9,000 into 2 divided by 3 into 3 into 3. Okay. So amount is 14,400. So here Plastic will also pay, read out the question, Plastic will also pay a cash consideration of 27.5 cents on first January 20x5 for the each acquired share in the Subtract. I have also told in the previous video, when we used to study the F3, there are two types of, there is the share consideration and cash consideration and mix up of both. But in F7, you also have to study like some more consideration like deferred consideration, contingent consideration. Deferred consideration means in the coming future, in certain date, you have to pay certain amount, okay, which will be given in the question. And contingent consideration means it's like a probability. There are certain conditions attached with that amount. If that conditions are met, then you have to pay those amount, otherwise not. Okay. So 50% probability is there whether the conditions will be met or not. Okay. So this one is the deferred consideration because the Plastic will pay cash consideration 27.5 cents. Again, you have to be you have to be careful because here the cash amount is given in the cents per share, and all the figures have been calculated in the dollar. So we will divide these amounts with 100, right? So that it can be converted into dollar. On 1st January 20x5 means from the acquisition date. 1 year from the acquisition date, you will pay this amount. So it is a deferred consideration. So here, Plastic has a cost of capital of 10% per annum. None of this consideration has been recorded by Plastic. Okay, so it means both share exchange and cash deferred consideration has not been recorded by the parent. So here we will pass a journal entry. I will write in the shortcut JE. So first debit will be investment, right? Investment amount is and credit will be share capital. For share capital, what you need to do is just have a look on the formula bar. I am making some changes in this figure. So this 3 is the market value. Okay, so share capital will be number of share into the nominal value, right? So here we will multiply with 1, not 3, because 1 is the nominal value. So just have a look on the formula bar. I am just making a changes. Okay, all things will remain same except we have to just multiply with the nominal value, not with the market value for the share capital. Now credit share premium, because 3 out of 3, 1 is nominal value, excess amount is the share premium amount. So we will simply subtract these two. So we will get the share premium. So now second consideration is the deferred consideration. Okay, so deferred consideration amount is 27.5 cents for each share acquired in the Subtract. Okay, so here I will show the calculation. How much share is acquired from the Subtract? 80% of 9,000. When we will multiply 80% of 9,000, we will get the number of share acquired in the Subtract. Okay, right? And we will multiply with the cash paid per share by the parent, which is 27.5 cents. Okay, so we will just change it into the dollar or convert it into the dollar. 27.5 divided by 100. Okay, so here we will write the final figure, and 80% into, you don't have to show this calculation as I'm showing right now, because you just only put on the make everything arrange on the formula and just enter the, you will get the final figure into 27 point. Just a bit. Okay. Yeah. So you don't have to show this calculation. You can just end with this final amount. No issue. I'm just going to get you the what I am exactly doing. Okay. So total purchase consideration equal to, we will add these two amounts. Okay. So okay. One more thing you have to do is, in case of a deferred consideration, we have to unwind. So, sorry. First, we need to find a present value, because 1980 is the future value. We will pay this amount in the future. So, we need to convert this amount into the present value. And we have given the cost of capital percentage in the question as well. And I think formula is given in the book of the F7, and we have already studied in the F2 as well how to calculate the present value. So I will suggest to just go through the book and just have a look on the formula. So here I will show you what I am doing. 1980 into, we will take 1 divide by bracket 1 plus 10%, 0.10 power 1, because after 1 year we will pay this amount. So I have just yeah, okay. So I have just square with the 1, power, multiply it with the 1. Into 1 divided by 1.10 power. In case of 2, like if this amount has to be paid after 2 years, here we will do power 2. But here we will pay this amount after 1 year, so we will only do 1. Okay. So 1981. Okay, yeah, fine. So this is the present value. Okay. So now we have to do unwinding of discount. So here debit entries, journal entries, debit finance cost, okay, and credit deferred consideration. So we will just take present value and multiply with the cost of capital, which is given in the question, which is 10%. But this 10% is for the per annum, and the time of acquisition is only 9 months. So we will multiply with 9 divided by 12 as well. The amount is 135. So okay, we have done with the working 1. So now we will read the additional information one by one. Here we will write down heading additional information. Okay, so this is the profit and loss and financial position given for the individual entity. So okay, the first information is, at the date of acquisition, the fair value of subtract assets and liability were equal to their carrying amount, with the exception of the subtract property, which had a fair value of 4 million above its carrying amount. For consolidation purpose, this led to an increase in depreciation charge in cost of sales of 100,000 in the post-acquisition period to 30 September 2024. Subtract has not incorporated the fair value property increase into its entity financial statement. Okay, so this is the basically fair value adjustment. So every adjustment The amount is 4 million, which means 4,000. Here, be careful whether question is saying the above or below. Here the question is saying above. It means we will add this amount while in the working to in the net asset of subsidiary as well. We will add this amount while preparing the consolidated financial portion in PPE. Right? So we will calculate post acquisition depreciation. But here in this question, it has already been calculated and shown, which is 100. We have already taken the 30 common. Okay. Okay. So then, okay. The subtract has not incorporated the fair value property increase into its financial statement. Okay, so we need to record it. So I will just pass a journal entry. Okay, so here journal entry. So debit, this amount will be added to PPE. So PPE 4,000. Okay, and credit net asset list of subsidiary while calculating working to both at the acquisition as well as on reporting date. The amount is 4,000. Okay, so for the post acquisition depreciation, the amount is 100 and journal entry is debit net asset list at the reporting date. Only from reporting date we will subtract this amount 100 and credit PPE. Okay, so next what the question is saying, the policy of plastic group is to revalue all property to the fair value at the each year end. So on 30 September 2004, the increase in plastic property has already been recorded. However, the further increase in 600,000 in the value of subtract property since its value at acquisition and 30 September 2004 has not been recorded. So this is the post acquisition revaluation surplus. Amount is 600. Okay. So while dealing with questions, we will know what to do with this amount. Okay. So next information is, this is for the 1 and 2. Okay. On 30 September 2004, Plastic accepted 1 million loan, 10% loan note from subtract. Okay, it means subtract given loan to parents. So one thing I would like to say here, if at the date of acquisition, parent or subsidiary have given loan, in that case we won't cancel it out. But in during the period or in parent or subtract has parent or subsidiary has given a loan to each other, we need to cancel it out. So be careful while reading the question and doing solving the question whether the loan is during the period or at a time of acquisition. Okay. The loan amount is a loan amount is 1 million. So we have taken the 30 common, so 1,000. Okay. Okay. So on 30 September 2004. Okay. Third point. What the third point is saying? Sales from plastic to subtract. Sales from plastic sold to subtract. It means parent sold to subsidiary. Throughout the year, in the 30 September 2004, had a consistently been the 300,000 per month. Means selling is 300 per month. So time of acquisition is 9 months. We will take 1000 common, so 300. It means 2700. And plastic make a markup of on cost 25%. Markup equal to 25%. On all these sales, 600,000 at the cost to subtract inventory as of 30 September 2004 had been supplied by plastic in post acquisition period. So unsold amount is 600. So basically this is a selling price. Don't get confused with the at the cost to subtract. Obviously the cost at which the subtract purchase from the parent, it's the selling price for the parent, but same will be the cost for the subsidiary. So it is a selling price, not the cost. Just be careful with the sentence. So unsold 600. We will calculate the PUF here. We will simply multiply these two items. We will multiply this unsold amount with 25 divided by 125 because markup is charged on the cost, but the selling price is given. So selling price will be 125%. Okay. So now what the next point is saying, plastic had a trade receivable balance owing from subtract of 1.2 million as at 30 September 2004. This referred to the equivalent trade payables of subtract due to the payment by subtract of 400,000 made in September 2004, which did not clear plastic bank account until 4 October 2004. Both entities have an overdraft rather than the positive cash balance. Okay. So we need to add the row. Okay. So for number so plastic have a trade receivable balance to be payable from the subtract. So this need to be cancelled out because it is intercompany transaction. Okay, so we will credit receivable to get it cancelled out, which is 1200, but this amount not match with the payables, but this amount don't get matched with the payables of subsidiary. So due to the the subsidiary has made payment. This refer to the equivalent trade payable of subtract due to the payment by subtract of 400,000 made in September 2004, which did not clear plastic bank account. So it means the plastic had and subtract had made payment, but the plastic have not received or not recorded, we can say. So it means we will assume it has been received for the consolidated. So I will write in the shortcut CIT, which means cash in transit debit, and the amount is 400. So difference between these two is your payable amount. So debit payables to get it cancelled out. Okay. So next in point is plastic policy is to value non-controlling interest at a fair value at the date of acquisition. For this purpose, subtract fair price at a date can be deemed to be representative of the fair value of the share held by the non-controlling interest. Okay. So in F7, you can calculate a non-controlling interest value by two methods. One is the fair value, which we have already studied in the F3, and the second one is the proportion method, where we will take the NCI percentage and just multiply with the net asset at acquisition. So here the NCI at fair value at acquisition equal to, what is the NCI percentage? 20%. 20% into total number of shares of subsidiary, which is 9,000 already given, and we will multiply with the market price of subsidiary, which is given in the question above, here 2.50. So 2.50. Okay. So next point is 6. Assuming, except where indicated otherwise, that all items of income and expenditure accrue evenly throughout the year, subtract profit for the year ended 30 September 2004 was 2 million. So basically this information, profit after tax of subsidiary, is given for calculation of, just wait. Okay, So calculation of net asset, retained earnings at acquisition. Okay, so in previous video I have given the formula how to calculate. So if you have watching that video, you can have you can easily calculate. So I will explain once more. So we will take the retained earning at reporting date from the balance sheet of subsidiary, which is given 3500. Okay, 3500, and we will minus the post acquisition profit, which is the 2000 into 9 divided by 12. So 9 months is our post acquisition period. So retained earning at acquisition is 2000. So just have a look on the formula bar how I calculate this amount. Okay, so now let's move to the working 2. Working 2. Working 2 is for the net asset of subsidiary at fair value at acquisition, at reporting date, and post acquisition reserve. Okay. Okay. So now first we will take a share capital of subsidiary at reporting date, which is given in the question 9,000, and we will assume it will be same on the acquisition date. So then we have a revaluation surplus nil. Okay, retained earning at reporting date is 3500. On acquisition we have calculated above. Yeah, 2000. So what more things we need to be recorded in the working 2? In case the subsidiary sold goods to the parent, in that case we need to subtract POP from the working 2. But here parent is selling to the subsidiary, so POP will be subtracted from the working 5. Okay. So next fair value adjustment, yeah, which is in the additional information. Fair value adjustment amount is 4000, I think. Yeah, 4000, and it will be same on reporting date as well. So now post acquisition depreciation, we will only subtract it from the reporting date. The amount is 100, and anything else to be recorded here? No, I think this much is okay. Total sum and difference between these two is the post acquisition reserve, which is divided in between the parent and NCI. So now we will move to the working 3, which is for the goodwill, right? So we will first record FD consideration paid by parents. Amount we have already calculated above. This total total purchase consideration. Here we have 16,380. Then we will write down fair value of NCI at acquisition. We have already calculated this amount in the additional information section. So NCI at fair value is on the 0.5, 4500, and we will subtract less net asset at acquisition 15,000. So if in the question, if there is given like goodwill impairment, so we will deduct goodwill impairment from the working 3 as well. So nothing such like information given in the question. So the goodwill is anything else we are missing? Unsold pulp, Learning post acquisition reserve. So okay. Actually, the total will be this amount and present value. We have just added the future value. Okay. Now total is, sorry, I did a mistake in the calculation. We will add the deferred consideration present value and share exchange amount. So by mistake, I have just added the future value. Oh. Okay. So now we will do the working 4, which is for the NCI. So fair value of NCI at acquisition. The amount is, we can just copy paste from here. Then post acquisition reserve. So NCI percentage is 20%. Post acquisition reserve is 1400, which we have already calculated in the working 2. So 20% into 1400. Okay, and then post acquisition revaluation surplus, which we have note down in the additional information. So in case of post acquisition revaluation surplus, we will take the NCI percentage of revaluation surplus and added it on the working 4. So here NCI percentage is 20% and post acquisition revaluation surplus is 600. So we will add the NCI percentage here, and then rest 80% will be shown in the consolidated statement of financial position in the equity section. So here we don't have a goodwill impairment. In case of a goodwill impairment, we will take the NCI percentage of goodwill impairment and subtract it from the working 4, but we don't have such thing like that. So NCI amount at reporting date is some. Okay, so now we will do working 5, which is for the group retained earning. So parent retained earning, which is given in the question, you can have a look on it, 6300. Then we will add post acquisition reserve. So parent percentage is 80% into post acquisition reserve, which is 1400. Then we will minus POP, right? So POP amount is 100, or you can go through like this. Sorry, 120. Okay. So in case of goodwill impairment, we will subtract the parent portion of goodwill impairment from here. So we don't have such information like that. So group retained earning equal to okay. One more thing we need to deduct is here is, so less finance cost ब्रैकेट में unwinding. ठीक है. So we have already calculated in the additional information, sorry, in working 1. Yeah, it is 135. Now okay, so let's move to the requirement of the question. Okay, the first is, okay, so plastic extracts from consolidated statement of profit and loss. I will write in the shortcut, for the year ended 30 September 20x4. Okay, So we only need to calculate the three figure, which is the revenue first, revenue, then is cost of sales, then finance cost. Okay. So this one we will add one more box. Okay. So parent, subsidiary, group adjustment, group. Our parent's revenue is, will look in the question given, yeah, it's 62,600 and subsidiary is 30,000, but the time of acquisition is 9 months, so we will take the each and every PL item 9/12 portion only. So because in the PL item each and every item is for the whole year, so time of acquisition is only 9 months. That's why we have done 9/12. Okay, and we will eliminate intra-group transactions. Here parent sold goods to subsidiary, so amount is 2,700. Okay, so we will just add these two amount and eliminate the intra sales between these two companies. So now cost of sales, we have 45,800 for parent, and for subsidiary it is 24,000, but we will only take 9/12 portion. So and also again we will eliminate intra-group sales. One more thing we need to remove is here PUP, post-acquisition depreciation. Here in question it has been mentioned that post-acquisition depreciation should be charged on the cost of sales. Even the question have not shown anything. If the question is silent on this matter, then we will still charge it on the cost of sales, but you have to be careful. Sometimes it might be said that you need to charge it on the administrative expense. So be careful with what the question is saying. But if nothing has been mentioned or question is silent on this matter, so just you need to charge it on the cost of sales. Okay. So here the PUP amount is we have calculated here PUP. Yeah, PUP and post acquisition depreciation 100. So what is the cost of sales? We will just add cost of sales of parent, subsidiary, and we will also add the PUP amount and also add post acquisition depreciation, and we will only subtract the intra sales because we need to eliminate this. So 61,320 is the cost of sales. Now next is finance cost. So finance cost of the parent is 200 and subsidiary is 0. So one more thing we have to write, make adjustment is we need to add the unwinding of discount finance cost. Here we have past journal entry. The amount is 135. So but here you might have a question that during the period of subsidiary has given loan to parents, so why don't you take the finance cost of that loan? So we don't have to take the finance cost of this loan amount because it has been given on the reporting date. So no finance cost has been charged on that date. So that's why we haven't taken any finance cost related to this loan amount. Okay, so that's why don't get confused with the date. Date is very important. Don't just overlook the date. Okay, each and every information is very important. So 135. So we just need to add this both amount. So 335 is finance cost. So now we will prepare the consolidated plastic consolidated statement of profit or loss, statement of financial position, okay, at 30 September 20x4. Okay, we will add one by one each and every item. So only few adjustment or new item need to be just write on the financial position statement. So NCA, first is NCA, which stands for non-current assets, right? Non-current assets, property, plant and equipment, PPE. So just have a look on the formula bar what I am doing. So I have taken the parent PPE plus the subsidiary. So don't just apportion like we did in the profit and loss 9/12 for the each and every item. So we don't have to do these things in case of a financial position. Just add line by line item, nothing else we have to do. And one more thing here we need to adjust is the fair value adjustment and post acquisition depreciation, which we have mentioned in the additional information. Fair value adjustment is 4,000. And we will minus post acquisition depreciation, which is 100, and again we will add post acquisition revaluation surplus, which is 600. Okay, the amount is 37,100. Okay, then next item is investment. Okay, the investment amount is 1,000, but subsidiary has given loan to the parent, so it is also one kind of investment. So need to be eliminate intercompany transactions. The investment amount will be 0. So instead of it, we will note down the goodwill, which we calculated in the working 3. Just give hints over here. Then goodwill is 5,700, right? So total net non-current asset is so now we will look after the current asset. So we don't have given any specified current asset. Just it has given a total in the statement of financial portion of the both the entity. So just have a look on the formula bar what I am doing. Okay, so what is the current asset of the parent? 9,000 plus 4,000 of subsidiary, and we will remove POP amount because if here inventory amount has been included in this total amount of current assets, so we need to eliminate all the current asset items which we have recorded in the additional information. So first is the POP. We will remove the POP. Okay, so POP is 120. Then next is yeah, here CIT, we will add CIT. We will assume the cash has been received, and we will eliminate the receivables, which is 1,200. Anything else? No. Okay, this much is for the current assets. So total assets equal to this plus this. Okay. So now we will move to the equity and liabilities section. Okay. So we will take here share capital first, which is given in the question. So don't add the parent as well as subsidiary share capital, because for the subsidiary share capital we already have included this amount in the while calculating the working 2. So we will only take the parent share capital, which is 10,000. And one more thing we need to just add here is the share consideration which has not been recorded by the parent. A question has already mentioned at the start of the question, we can see. So share consideration has not been mentioned by parent, so we need to add share consideration amount. So we have passed journal entry as well. So share capital is 4,800. We will add this to the share capital of parent, and then we will write down share premium. Share premium is share premium, yeah, 9,600. Okay. So then retained earning, revaluation surplus, sorry. So revaluation surplus, we will take the parent, subsidiary don't have any revaluation surplus, but post acquisition surplus that the subsidiary have, we can see in the additional information. So we will add only 80%, because 20% have been recorded in the working for the NCI. So we will take 80% of post acquisition revaluation surplus, which was I think 600. So overall revaluation surplus is 2480. Then retained earnings we already have calculated. So we will take the group retained earnings here, group retained earnings, which we have calculated in the working price, just to give the indication here that we have calculated it in the working price. So just working price. Okay. So we will also write down here NCI, which we calculate in the working for. So tab working for 49. Okay. So anything else need to be recorded here? No, I don't think so. So total is total. Okay. So now we will record the non-current liabilities, which is for the parent is 2,500 and subsidiary 1,000, but subsidiary has given loan to parents, which needs to be eliminated. So 1,000 will be eliminated from here. 2,500 non-current liability, and current liability is payables. So add the parent and subsidiary payables, and we will eliminate the payables which intercompany current account payables which we have recorded in the additional information 800 need to be eliminated. So one more thing we need to be recorded in the current liability is the deferred consideration we have calculated in the total purchase consideration in working 1. So we deferred consideration need to be paid within the 1 year. So we need to record in the current liability. So we will add present value. Just go through the journal entry we have passed. Yeah. So we will add the present value plus finance cost. Okay. So total equity and liabilities equal to SUL both got matches. Yes, so it means our statement is correct. Okay, so in this video we will do this for this much for today, I mean. So in next video we will do the next question. So see you in the next video. Thank you guys for watching my video. So if you like my video, please subscribe to my channel and hit the bell icon so that you can get the latest video. So bye bye, take care.